Chapter 11, bond valuation. We're going to talk about bonds. Behavior of market rates, term structure of rates, valuing bonds, measures of yield, duration, and bond investment strategies. That's the return on a bond. The real risk-free rate plus the inflation premium plus some type of risk premium. We looked at this in 331 in a little bit more depth. The discount rate is the opportunity cost of capital. That's always true. It's always the rate that can be earned on bonds of similar risk and maturity. That's the way we put it out in 331, where that's the real risk-free rate, that's the inflation premium. When you put those two together, that's the nominal risk-free rate. There's a maturity risk premium, a default risk premium, and a liquidity premium. Corporate and treasury bonds are going to have, long-term, are going to have a maturity risk premium. The longer you want my money, the more you have to pay me. Treasuries are not going to have a default risk premium because they're not going to default. And treasuries are not going to have a liquidity premium because they trade in a very liquid market. So corporate's going to have all of those. Government's only going to have the first three. We got kind of three different sets. We've got the U.S. treasuries, we've got municipals, and we've got corporate bond issues. And there isn't a single rate that applies to all of that. We look at the spreads between them. Municipal bonds rates are usually lower than corporate bond rates because they're tax exempt, and that's extremely attractive. The higher your tax bracket, the more attractive that is. Revenue bonds pay higher rates than general obligation bonds because they're riskier. Treasury bonds are lower because they don't have any default risk. The lower the credit rating, the higher the risk, the higher the rate you have to pay. AAA allows them to pay the lowest coupon rate. Longer maturities have to pay more. Again, just intuitively, you want my money for longer, you have to pay me more. Freely callable typically pay higher than non-callable. So there's a little thing. Inflation is the most important thing that affects our market rates. If inflation goes up, interest rates go up. That's just how it is. Remember those first two elements there, the real risk-free rate plus the inflation premium. In truth, that inflation premium is the expected inflation premium. It's what you think is going to happen. There's 5 other variables. This shows you inflation. Blue is inflation, red is interest rates. So inflation goes up, the interest rates generally go up. Change in the money supply, this is kind of interesting. Look at it. A slow increase or decrease has the opposite impact. It slowly increases, the rates go down. But a fast increase or decrease has the direct effect. The federal budget, if they have a deficit, interest rates go up. Surplus, they go down. Economic activity, no surprise, in a recession, rates go down. Fed policy, we talk about that in 333, how the Fed uses open market activities for expansion or contraction. If they want the market, if the economy to expand, they decrease market rates to get people to invest. If they want to contract, they increase rates. And foreign interest rates, they kind of go, it goes together now. The way things have gotten in markets in general, markets are tied together a lot just because of technology. We all know what's going on all over the world. So when anybody else's rates go up, it kind of drives us up. Term structure. The term structure is the relationship between yield and time to maturity. You pick a similar class of securities and do it. Typically the yield curve, it can either be upward sloping, which is normal, or downward sloping, or what's called inverted. Upward sloping, most common. The reason is we typically expect long-term rates to be higher than short-term rates. Same reason back there, back up. You want my money for longer, you have to pay me more. Inverted is unusual. It can be flat, and it's possible. It can be humped, really unusual. You can plot the curve. Typically, they use treasury securities because they don't have default risk, they're actively traded, the prices are easy, and they're relatively homogeneous. You can do it with other things. There's what 2 look like. This was March 7th, 2007. This was March 16th, 2015. It was upward sloping then, and it kind of taken a curve. And there's where they got those numbers from right there. They used the 1 month, 3 months, 6 months, all the way out to the 30 year. No surprise, they go up as you go further out. There's 3 basic explanations for why the term structure curve, why the curve looks like it does. Expectations, liquidity, market segmentation. Expectation says the curve reflects investor expectations about the future. If we think rates are going to go up, then they'll only purchase long-term bonds if long-term yields are greater than short-term yields. The yield curve will be upward sloping. If they expect them to go down, they'll only purchase short-term if they think short-term yields are better than long-term, so it'll be inverted. In other words, they're going to take advantage of the best thing they can find. Liquidity says long-term bond rates should be higher because of the added risk of longer maturity. Again, the longer you hold my money, I want more money for it. I want more return. They're less liquid, greater interest rate risk. And borrowers will pay a premium because they're locking in funds. Market segmentation kind of hits in the middle here. It says different financial institutions and investors have a preference. They may always want to be in 10-year notes, or they may always want to be in the long bond. So the rates have got to be extremely attractive to get them out of their preferred segment. Well, upward sloping, rising interest rates, lender preferences, greater supply of short-term money. Downward sloping, expectations either way. The yield curve. Now, why do you need to know about this? Because what the yield curve looks like is telling you about where we think interest rates are going to go. And what's the bottom line of everything about investing is what's money. What does money cost? If the yield curve begins to move up, that's assumption that inflation is going to be increasing, interest rates are going to rise. So investors are going to turn to short-term or intermediate bonds. If I think long-term rates are going to rise, I'm only going to invest for the short term right now, waiting for the long-term higher rates. In other words, I'm going to park my money for now until I can get something better. Consider the difference, the steepness of the curve. A steep curve is bullish. Flatter curve is less so. Pricing of bonds. You all have all had 331, so you all know how a bond is priced. We're going to look at bond value. Bond has 2 types of cash flow. Periodic interest, and you get your money back at the end. What do you need to do it? The coupon payment, the par value, the number of years remaining, and the market yield. You can see the formula down there. This is a $1,000 par value, that's your future value. It's a 20-year annual payer, and it pays 4.5% compounded annually. So it pays $45 a year. Market yield is 5%. There's your solution. Present value is going to be negative because that's what you have to pay to buy the cash flow stream of $45 a year and the $1,000 back at the end. We all know bonds do not pay interest annually. Let's move right on to semi-annual. In fact, most bonds, in fact, all of them that I know of, pay semi-annually. You have to make adjustments. You have to cut the coupon in half. It's how much are you being paid every 6 months. You have to multiply in by 2. It's not the number of years, it's the number of 6-month periods, and you have to cut the yield in half. Now, fortunately, by convention, the yield of maturity on bonds is quoted as an APR, which means you can just divide it by 2. No fancy calculation required. So here's our semi-annual. Same bond, same 4.5% semi-annual now. Those are the ones that I adjusted. 20 years became 46-month periods, 5% yield of maturity became 2.5, and $45 cut in half. This we probably haven't done before, accrued interest. Bonds pay interest every 6 months. If you sell a bond between 2 interest payments, the one who owned it before, it deserves to get the interest for the time they owned it. That's what accrued interest is. The clean price is the price we've learned to compute right in your calculator. The dirty price adds accrued interest. Here's how you do accrued interest. Par value 1,000, coupon 6%, pays $30 every 6 months. The last coupon payment was 2 months ago. Now, we're going to do this really easily with months. The actual truth is, in the bond market, it's number of days, and it's based on how many days there are in this year. In other words, leap years are different, you know. Yeah, we're not going there. We're not getting that deep in. It's the concept we're concerned with. If he sells this bond, he's due the market price plus 2 months of interest. Accrued interest is a third of $30, so he's due $10. The dirty price is $10.20. Its market is $10.10, and he's due another $10. Measures of yield. 3 basics: current yield, yield to maturity, yield to call. From 331, you know how to do all 3 of those. Expected return, expected versus actual. Okay, current yield, it's easy. Annual interest income divided by the current price of the bond. This is what's quoted in the press. When there are quotes on bonds, current yield is what they provide. Yield to maturity, that's the one we have to solve for because we can't observe it. We can observe the price. First thing we learned how to do is compute the price of a bond. But the truth is we can observe the price because it's quoted. We can't observe, we can observe the coupon, we know how long the maturity, we can't observe the yield. Most important, most widely used. If you buy a bond today and hold it to maturity, the yield to maturity is exactly what you will earn, assuming it makes all its payments. And you think about what we looked at in 331, where if you buy it at a discount or you buy it at a premium and it converges, it's forcing the yield to maturity to be whatever it is. It implicitly assumes you can reinvest your coupon payments at the bond's yield to maturity. It is the internal rate of return on a bond. Yield to maturity, annual compounding, 7.5% coupon, so $75, $1,000 par value, 15 years to maturity, currently trading for $809.50. Present value is negative, solve for IY, 10%. Semi-annual, you need to multiply by 2. Same setup, but semi-annual, when you get that 4.987, you have to multiply by 2. Critical assumptions. With yield to maturity, you are assuming that you're going to hold the bond to maturity, that each payment is reinvested for the remainder of the life at a rate equal to the yield to maturity. We never talked about that in our valuation, but that is that's a built-in assumption. And that you reinvest the interest on interest at a rate equal to the yield to maturity. If you think about it, yield to maturity is a market rate, so that's not it's not totally off the wall assumption, but that is built into it. Now, what about zero coupon bonds? They refer to equation 11.4 and 11.3. You can use them, and we're going to look at how. Today you buy a 15-year zero coupon bond, you buy it for $3.15. If you think about it, savings bonds, that's what a savings bond is, exactly. You buy it for $3.15, you hold it to maturity. What's the yield of maturity with annual compounding? Well, they've done it as a formula. Semi-annual, you actually value a zero with semi-annual compounding. 30 periods, you bought it for $3.15, you're not getting any coupon interest, but you're going to get $1,000 back at the end. That's the answer, and you do have to double it. Yield to call. We did that one too. Yield to maturity. If the bond is selling at a high premium, yield to maturity may not be a good measure of return, because if market rates drop enough, it can be to the company's advantage to call the bond issue and reissue at a lower rate. Yield to call. 2 major changes. N is now the time to first call. It's the investment horizon. Future value is the bond's called price, which includes the premium. So here we have 20-year, it's an annual payer, pays a 10.5% coupon. It's a deferred call bond, trading at 12.04. It can be called in 5 years at a call price of $10.85. Those are the 2 changes you need to make. The payment's still the same. What it's selling for is still the same. Solve for yield to call, and it's 7%. Now, think about it. It's paying 10.5, and yield to call is 7. What do you think is going to happen? They're going to call it in if they can. Yeah. Investors who actively trade bonds, they're looking at expected return. They're not planning to hold them to maturity. That's not what they're doing. This is the rate of return you can expect holding it over a time less than the total life. What you have to do is estimate what you think the price is going to be. Like, if I think I'm going to hold this a year, what do I think the price is going to be in a year? Well, the maturity went down 1 year, but you're having to estimate what you think the yield's going to be in a year. There's a lot of uncertainty built in. This is semi-annual compounding. Holding period, 3 years. It's paying 77.5, so it's paying semi-annual, $37.50. I'm buying it for $809.50. I'm thinking it's going to make it to $960 in 3 years, or 6 periods. That would be your answer, 7.217. That's a lot of estimation about what you think is going to happen in the future. Valuing a bond. Conservative investors, they focus on the yield of maturity. Their primary objective is getting the income. You buy a bond because it's fixed income. That's the whole point of it. More aggressive traders, they trade on interest rate swings. They may be looking strictly for the capital gain side of this. They're looking at more active trading. Duration, it says it measures bond price volatility. It indicates how the bond's going to react in interest rate environments. Duration is actually the average life of the bond. That's what it is. The average time it's going to take you to get your money back. Higher coupon bonds have shorter durations because you get more money sooner. Longer maturities have longer durations. Think about what a bond's cash flow stream looks like. Coupon, 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 $1,000. So the further out that 1,000 is, longer duration. Higher yields, shorter durations. Shorter duration, less volatility. We're going to look at examples of this. It is the weighted average life of a bond. There's 2 types of duration, Macaulay and modified. That's Macaulay right there. They are taking the present value of each cash flow and dividing it by the bond's price and multiplying it by, and we are not going to look at semi-annual. We are only going to do annual duration. So T is the year. Add all of those up, and that's the duration. Find the present value of each coupon or the principal payment. You're using the current yield of maturity as the discount rate. Divide that present value by the market price of the bond. That's the weight. Multiply by the year that the cash flow is going to be received. Repeat all of that and add them up. Okay, here's an example from the book. This is a 7.5% 15-year bond price to yield 8%. There are your years. It's getting a cash flow every year of $75, and then you get $1,000 back with the last coupon. Taking the present value of each one of those, if you add that up, that is the bond's price right there. Present value, if it's cash flows, that's the price. So you divide each one of these by that. Then you multiply that times the year number. That's over here, and you add that up. The duration is 9.36 years. That's what it looks like. This is posted out there. There it is. Yeah. This is Macaulay duration. Modified is coming up. 75 divided by 108 to the first, second, third, etc. Now in Excel, this is a piece of cake. The sum here is the price, the $957.20. Divide each one of those by $957.20. Multiply that times the year. Add them up. That was what we just looked at. As the yield of maturity changes, it will change. The duration of a portfolio is a weighted average of the durations of the bonds in the portfolio, with the weights being how much money's in each bond. What duration does, it predicts price volatility as long as the swings aren't huge. But interest rates actually don't change. Bond prices change in a nonlinear fashion. This doesn't exactly work. This is modified duration. Look at the formula. It is Macaulay duration divided by 1 plus the yield. And the percent change in a bond price. It is -1 times modified duration times the change in interest rates. If the change in interest rates is positive, then the bond price will go down. Because the interest rate is a discount rate. If it goes up, the bond price goes down. That's what that is predicting for you. And yes, we're going to look at some right here. 15-year, 7.5% bond, price to yield 8%. We just looked at, this is the one we did duration on. Macaulay duration's 936, modified is 867. If the market rates increase 50 basis points, that's 0.5%, from 8 to 8.5. The percent change in the price is going to be -1 times the modified duration times the change in rates. So 0.5% increase in interest rates is going to cause the bond price to go down 4.33%. There's another measure, an effective duration. It's an alternative, and you can use it for bonds that may be called or converted or whatever, because Macaulay, and even modified is based on Macaulay, and they don't work very well with embedded options. So here's what you look at. You take the bond right where it is. You calculate a new price if the rates go up and another price if the rates go down. And effective duration is the larger, if the rates go down, minus if they go up, divided by 2 times the original bond price times the change in interest rates. And here's how that looks. 25-year bond, 6% coupon paid semi-annually. Current price is $882.72. The yield is 7%. If the yield goes up to 7.5, the price comes down to $831.74. If it comes down to 6.5, the price goes up to $938.62. There you go. 938 minus 831 divided by 2 times the original price times the change in interest rate, which was 0.005. So effective duration was 1211. I don't think on any of these, duration is probably the most involved one of them. And in most of them, like this, is just a formula. If you know what to plug in, you got it. I mean, the math is certainly not hard. Duration is a technique. Bond immunization. This is a strategy to end up at a specific spot no matter what happens in the market. You want to offset the price and reinvestment effect. So you want to structure the portfolio so that you come out with exactly what you want in the end. I don't know how else to put that. The average duration of the portfolio is equal to the investment time horizon. Here's an example in your book. We're going to look at it on here. 10-year, 8% coupon bond. It's a duration of 8 years. The investment horizon is 8 years, so they're matched. You purchase the bond at par, but interest rates drop from 8 to 6 at the end of the 5th year. To really stay immunized, you do have to rebalance your portfolio. There it is. Market rates drop. Desired terminal value that I want is $1,000 times 108 raised to the 8th power, 118.50. Okay, here's what it looks like. The first year, you get the $80. You get it 8% for 4 years and 6% for 3 years. In the second year, you get $80 again. You only get the 8% for 3 and 6 for 3, all the way down. At the end, the bond price, that's the bond price, you get that. You come out with just almost exactly what you want. That's what it looks like, put out in Excel. And that is in the attachment. The first year's bond grows to that. First year's interest grows to that, all the way across. All the way down. Here I find the price of the bond, the value of the bond. When I want to sell it, it's still got 2 years left. My horizon is 8 years. The bond is 10. So it's still got 2 left. Current yield of maturity is 6. So I can sell it for $1036.67. You put all that together, and you come out 60 cents away from exactly what you wanted. Bond investment strategies. Passive. No transaction cost. It's the buy and hold. Bond immunization, buy and hold. Those are passive strategies. Somewhat passive, these bond ladders. You start off by getting bonds with 3, 5, 7, and 10-year maturities. And as the 3, 5, and 7s mature, you buy a 10. And then you've got a kind of a rolling ladder of bonds. That's what they're talking about. Market timing. These people are trying to, basically they're trying to make money buying and selling bonds just like you would stock. I'm watching for the price to change and I'm going to buy and sell. Bond swaps, you sell one bond and buy another bond in its place. You could take advantage of shifts in interest rates, better bonds available with a good price. You could do it for tax purposes. The thing you have to be careful of, are they going to come? Yeah, I think it's on this one. And they switch out of a low coupon into a higher coupon to get the yield. You've got to be careful on transaction cost on bonds, on trading anything. And you also have to be careful if you're doing something for tax purposes, Here we are at tax time, everybody. If you literally sell a bond and buy virtually the same thing back, that's considered a wash sale, and they're going to get you on it because you're doing it just to get the tax advantage. Sell a bond that's declined in value, use the capital loss to offset other capital gains, and get another bond. The new bond can't be identical to the one you sold because that's considered a wash sale. And you're just doing it to take advantage of the tax situation. This duration, this is under exhibits, duration example. This is the one that was in the PowerPoint and in the chapter. And there's some others out here from some of the problems. And this is the immunization example. So you can go look at those. You're considering the purchase of a $1,000 par value bond with a 6.5% coupon, paid semi-annually, matures in 12 years, priced to provide a return of 8%. What's the price? Now, this one you should be able to get because this was just straightforward, semi-annual, 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 $1,000 par, plug it in. That was your basic bond. Number 3 says, using semi-annual compounding, find the prices of the following bonds. 10.5 15-year yield 8, 7 10-year yielding 8, 12% 20-year yielding 10, priced at 10%. And then repeat using annual. Okay. Here they all are right over here. Again, they were all in straightforward in your calculator. Here's what they're trying to show you. When it's semi-annual, there's your results. When it's annual, if the bond is selling, look at it, at a premium, then semi-annual is going to be greater than annual. If the bond is selling at a discount, then annual is going to be a bigger discount. See? This one's bigger, that one's bigger, that one's bigger. That's a bigger negative. Not by much, 85 cents, but it's a bigger negative. I am going to just make a rash assumption that y'all are all fine with calculating these in your calculator. Number 6, 20-year bond, coupon 10%, price to yield 8. Calculate the price using semi-annual. If the investor purchases the bond 2 months before scheduled coupon payment, how much accrued interest? Okay, here's the price right here. Again, it's straightforward in the keys. Over here, if they buys it 2 months before the next payment, then he's earned 4 months worth of coupon. That's where that's coming from. Like I said, that in real life, that's a lot more complicated than that. They actually base it on number of days in the month and in the year and leap years and all that kind of stuff. We're just going to go simply. How many months since you got one? How many months till the next one? We'll keep it simple. Okay, number 7. 3 years ago, you purchased a 10% coupon bond. It pays semi-annual interest, and you bought it for $9.75. What would be your bond equivalent yield if you sold the bond for the current market price of $10.50? Semi-annual, 3 years ago, 6 years, bought it for $9.75, pays $100 a year, so it pays $50. Thinking sell it, bond equivalent, you just double it. Semi-annual. Number 8, bond is priced in the market at $11.50, coupon of 8%. What's the current yield? Coupon is $80. Current yield is 80 divided by the price, $11.50. 11. An investor is considering the purchase of an 8% 18-year corporate bond priced to yield 10. She thinks that in a year, the bond will be priced in the market to yield 9. Using annual couponing, find the price today and the price in 1 year and the holding period return. Okay, here's the price today. Got 18 years, there's the price today. Next year, it's got 17 years and it's priced to yield 9. So there's P0, there's P1. It pays $80 a year, so do not forget to add the $80 in. You're going to sell it for this, you bought it for that, and you're going to get $80. Don't forget the interest on these. 10%, 25-year bond has a par value of $1,000, call price of $10.75. First call date is in 5 years, and coupons are paid semi-annually. Find the current yield, yield to maturity, and yield to call on this issue, assuming it's currently priced at $1,200. Yield to maturity, all of these are just standard. Yield to maturity, yield to call, current yield. Second part is if it is priced at $8.50. Yield to maturity, yield to call, current yield. And there's your recap. If it's priced at $1,200, you should expect yield to call. Premium bonds are likely to get called because they're paying higher than the market. Discount bonds, you can expect the yield to maturity. They're not going to get called. 22. Using annual compounding, find the yield to maturity for each of the following bonds. And so there, again, this is all straightforward. These are annual, non-callable. And then it says, now assume that bond A is callable in 7 years at $10.95, B is callable in 5 at $12.50, and C is callable in 3 at $10.50, and use annual compounding. And there they are. Remember, the adjustment for call changes the number of years and the future value in each case. So there is your recap for that. Price $16.84. There's your coupon. And for callable, when it's priced at a discount, look at the yield to call over here. Priced at a discount, your yield to maturity is higher. When it's priced at a premium, the yield to call is going to be low. And duration. A bond has a Macaulay duration equal to 9.5, yield to maturity is 7.5. What's the modified duration? You just divide it by 1 plus the yield. 24 says Macaulay duration 8.62 and a price to yield 8%. If interest rates go up so that the yield goes to 8.5, what will be the percentage change in the price? And if it goes down to 7.5, the current yield, where it's going. Modified duration is the Macaulay duration divided by 1 plus the yield. Change in rate is 0.5%, 0.005. So there's your formula, minus 1 times the modified duration times the rate change. So if interest rates go up by 50 basis points, the price is going to go down by right about 4%. And conversely and equally, if the yield goes down, the price is going to go up. And number 25 says, an investor wants to find the duration of a 25-year, 6% semi-annual pay non-callable bond that is currently priced in the market at 882.72 to yield 7. Using a 50 basis point change in yield, find the effective duration. Okay, effective duration, you don't have to do that whole thing. That's the price now, 882.72. Drop it down, drop the yield down by 0.5 point, and it goes up. Go up 0.5 point, and price goes down. And here's your formula right here. The price when the yield goes down minus the price when it goes up, divided by 2 times the original price times the change. That's your effective duration. 27. Which one of the following bonds would you select if you thought market interest rates were going to fall by 50 basis points over the next 6 months? Bond A, Bond B, or Bond C? What you're doing is using Macaulay and the yield to find modified and the rate change. Oops, that should be a slash. Bond B is going to have the highest change. If you think rates are going down, the bond price is going to go up. Bond B is going to go up the most. And here is our duration question. I want to get it on one side. Okay, there we go. Elliot Carlin, 35-year-old bank executive. He's just inherited a large sum of money, and he's spent a lot of time in investments, and he knows duration. He wants to use $1 million of his inheritance to purchase 4 U.S. T-bonds, and there they are. A is an 8.5%, 13-year, priced at $10.45 to yield 7.47. 7.875, 15-year, priced at $10.20 to yield 7.6. 20-year stripped, it's priced at $2.02 to yield 8.22. That's a 0. And a 24-year 7.5, priced at $9.55 to yield 7.9. He's asking for duration and modified on each one. And then what if he splits it among the portfolio? Quarter. And what if he does it 360, 140, 360, 140? Okay. Let's work on this guy right here. The annual cash flows. It pays an 8.5% coupon, so the cash flow is $85 a year for 13 years, and in the last year, he gets the $1,000 back. Discount each of these back at the yield to maturity. That's what each of those are, and add them up. Divide that by the price. Multiply times the year, add that up, there's duration. Then modified duration, you just divide that by 1 plus the yield. The duration of a portfolio is the weighted average of the duration of the assets in the portfolio, and the weights are the percentage of the dollars. It's just like the return on a portfolio of stock, exactly the same thing. So duration there and duration there.